Imagine a world where the ground beneath your financial feet suddenly gives way, where years of saving, of careful planning, are threatened by forces unseen, by events beyond your control. A world where the market crashes, inflation rages, or a silent pandemic sweeps across the globe, leaving economic devastation in its wake. We've seen it happen again and again. The Great Depression, a chasm that swallowed 89% of stock wealth. The 1970s stagflation, a slow burn that gutted bonds and savings. The 2008 financial crisis, a tidal wave that wiped out $10 trillion. The COVID crash, a sudden, brutal fall of 35% in just 3 weeks. The 2022 bear market, a relentless grind that crushed growth stocks by 70%. 5 completely different crises: a depression, inflation, a financial collapse, a pandemic, a rate shock. Each one unique in its terror, its origin, its impact, and yet through every single one, 3 positions survived. Not 4 positions, not 10 different strategies, just 3. The very same 3 that worked in 1929, worked in 1973, worked in 2008, worked in 2020, and worked in 2022. Warren Buffett, the Oracle of Omaha, currently holds 30% of Berkshire Hathaway's portfolio in position 1. Right now, central banks globally are buying position 2 at the fastest rate in 70 years. And despite every crisis, every crash, every panic, position 3 has delivered 10% annual returns for a century straight. These are not complex strategies. They are not exotic instruments. They are 3 positions that anyone can hold, but most people don't hold them. They chase returns, they buy what's hot, they panic during crashes, and they lose everything because they don't understand the pattern. The pattern that says, regardless of what crisis comes, depression or inflation, crash or pandemic, war or peace, 3 positions survive. They preserve wealth, they compound over time, and they position you to buy when everyone else is forced to sell. Let me show you exactly what these 3 positions are, how they performed through 5 completely different crises, and why right now, in 2025, the smartest investors in the world are positioned in these exact 3 assets. Because understanding this pattern gives you something most investors never have: certainty. Not certainty about what crisis comes next, certainty that whatever crisis comes, you'll survive it. Before I show you the 3 positions, you need to understand why 3 specifically. Why not 1 safe position? Why not 10 different positions for every scenario? Because financial markets have 3 fundamental states, and each of the 3 positions addresses one of those states. State 1 is deflation or crisis. Asset prices are falling. Cash is king. You need liquidity to survive and capital to deploy at the bottom. State 2 is inflation or currency debasement. Paper assets lose purchasing power. You need hard assets that can't be printed or devalued. State 3 is growth or recovery. The economy expands. Productive assets compound. You need ownership in businesses that generate real earnings. Every crisis in history falls into one of these 3 states or transitions between them. The Great Depression was State 1, deflationary collapse. The 1970s were State 2, inflationary destruction. 2008 started as State 1, then became State 2 when the Fed printed. COVID was State 1 for 3 weeks, then State 2 when stimulus hit. 2022 was a transition from State 2 back towards State 1. If you hold all 3 positions, you're protected regardless of which state we're in or which state we transition to. Position 1 protects you in deflation. Position 2 protects you in inflation. Position 3 captures growth over time. Together, they create what Ray Dalio calls the all-weather portfolio. Not because it performs best in every environment, but because it survives every environment. And survival is what matters. Because the investors who survive crashes are the investors who have capital to deploy at the bottom. And buying at the bottom, that's where generational wealth is created. But you can only buy at the bottom if you survive the crash. The three positions ensure survival. Let me show you how they've worked through 5 completely different crises. The Great Depression, 1929 to 1939. This is the ultimate deflationary collapse, the worst economic disaster in modern history. Let's see how the three positions performed. Position 1, cash and treasury bills. In 1929, cash was gold-backed. The dollar was fixed at $20.67 per ounce of gold. When the market crashed in October 1929, stocks fell 89% from peak to trough by 1932. But cash didn't fall. A dollar in 1929 was worth more in 1932 because prices were falling. Deflation meant cash gained purchasing power. Investors who held cash survived. They watched stock prices collapse. They watched real estate prices fall 50%, and they waited. Then in 1932 and 1933, when stocks were trading for less than the cash on corporate balance sheets, when entire buildings were being sold for the price of their lobbies, the cash holders bought everything at fire sale prices. Bernard Baruch held cash through the crash. He deployed it in 1932 and 1933. By 1936, he was wealthier than before the crash. Treasury bills, short-term government debt, performed even better. They paid 3 to 4% interest, while prices fell 25%. Real returns of 28 to 30%. Cash and T-bills were the ultimate deflationary hedge. Position 2, gold. Gold was fixed at $20.67 per ounce until 1934. So holding gold meant your wealth was preserved. But here's where gold became extraordinary. In 1934, Franklin Roosevelt devalued the dollar. He revalued gold from $20.67 to $35 per ounce. Overnight, anyone holding gold saw a 69% gain in dollar terms. Your gold didn't change, but the dollar price of gold did. This is why gold survives crisis. Governments can't devalue gold. They can only devalue their currencies relative to gold. Investors who held gold through the Depression preserved wealth during the crash and gained wealth during the devaluation. Position 3, the S&P 500 or equivalents. This is the controversial one because the S&P fell 89%. How did it survive? Time horizon. If you bought the S&P in 1929 at the peak and held through the crash, by 1945, you were back to even with dividends reinvested. By 1950, you doubled your money. By 1960, you'd quintupled. The Depression lasted 10 years, but the recovery lasted 30. The investors who held the S&P through the Depression and into the recovery created generational wealth, not by timing the bottom, but by owning American business for the long term. 3 positions. Cash preserved capital and allowed buying at the bottom. Gold preserved wealth and gained during devaluation. The S&P compounded for those who held through recovery. Together, these 3 positions allowed survival and prosperity through the worst crisis in history. The 1970s, stagflation, 1973 to 1982. This was the opposite of the Depression. Not deflation, but inflation. Not falling prices, but rising prices. This is where most traditional portfolios died. Let's see how the 3 positions performed. Position 1, cash and treasury bills. During the 1970s, cash was a loser in nominal terms because inflation was 7 to 13% annually. But treasury bills adjusted. T-bill rates rose to match inflation, eventually hitting 15% by 1981. If you held short-term T-bills and kept rolling them over, you matched inflation. You didn't get rich, but you didn't get destroyed like bondholders did. Long-term bonds fell 50% in real terms during the 1970s because they paid 3 to 5% while inflation was 10%. But T-bills kept adjusting higher. Preserving capital. Position 2, gold. This is where gold proved its inflation hedge. Gold began the 1970s at $35 per ounce. When Nixon closed the gold window in 1971, gold started rising. By 1974, gold was at $200. By 1978, $300. By January 1980, $850 per ounce. A 24x gain in 1 decade. Anyone who held 10% of their portfolio in gold saw that position grow to 50% of their portfolio by 1980. Gold didn't just preserve wealth during inflation, it multiplied wealth. This is why Position 2 exists. When governments print money, when inflation runs hot, gold is the ultimate store of value. Position 3, the S&P 500. Stocks struggled during the 1970s in real terms. The S&P went nowhere from 1968 to 1982. 14 years of flat performance. But with dividends reinvested, you still made 5 to 6% annually. That's below inflation. So you lost purchasing power, but you survived. And here's the key. In 1982, when inflation broke and Paul Volcker raised rates to 20%, when the economy entered recession and everyone was terrified, stocks bottomed. From 1982 to 2000, the S&P returned 17% annually, the greatest bull market in history. The investors who held the S&P through the 1970s participated in that boom. They didn't get rich in the 1970s, but they positioned for the 1980s and 1990s. 3 positions. T-bills kept adjusting to inflation, preserving capital. Gold exploded 24x during inflation. The S&P survived and positioned for the